myself Aditya P. Tripathi. I am here to start our discussion on a very interesting topic of statement of cash flows, which was earlier known as cash flow statement, but as per Ind AS 7 we are supposed to call it as statement of cash flows. So in today's lecture of mine, I'll be telling you, I'll be starting our discussion with a very interesting opening case on statement of cash flow. Then I shall be telling you about the need and purpose of statement of cash flow. We'll talk about cash and cash equivalents and their role into the preparation of statement of cash flow, and eventually I shall be telling you about the match classification of a statement of cash flow. That what is a match classification? Cash flow from operating activities, investing activities and financing activities and so on. So with this agenda, let me start with the opening case of a newly established company, that is Budding Entrepreneurs Limited. And I'm showing you the income statement and balance sheet of this company that is called Budding Entrepreneurs Limited. And if you look at the income statement of this company, it shows the EBITDA, that is earning before interest, tax, depreciation and amortization. That value comes to be 18,86,350. And then we have EBIT, that is earning before interest and tax, 13,91,350. And eventually earnings after tax of 8,75,262. So in nutshell, company is having the earning after tax of rupees 8,75,262. This is the income statement of this company, and remember, it's a new company. It's a new company, newly established company, and this is the income statement of its first year. And then comes the balance sheet as on 31st March 2021. If you look at the size of balance sheet, they have equity and liabilities, wherein we have shareholders capital, share capital, reserve and surplus, we have general reserve, and then we have surplus. Apart from that, the company is having 10% debentures, current liabilities, which comprises of accrued interest on debentures, trade payables, provision for income tax, making it a total of 88,36,350. This is the liability side of the balance sheet. And if you look at the asset side of the balance sheet, it has non-current assets, comprising of gross assets minus depreciation. They have inventory under current assets. They have trade receivables minus provision for bad and doubtful debts. They have advance salary paid, advance income tax paid, cash in hand at bank. So again, it is having a tallied balance sheet, having a size of 88,36,350. And now comes the problem. There is a chairman of this company, Mr. Kushagra, who is actually the chairman of this Budding Entrepreneurs Limited. And this company has recently completed its first year of operation on 31st March 2021. Now you will know about the very interesting discussion which will go on between the chairman of the company and the CFO of the company. So Mr. Kushagra, who is the chairman of this company, he is having a conversation with the CFO of the company, Ms. Hansa Kapoor. And following is the excerpts from their conversation before the meeting of board of directors, and they are planning to propose dividend for the current financial year. And before that meeting of board, there is a discussion, there is a conversation going on between Mr. Kushagra, who is the chairman of the company, and Ms. Hansa Kapoor, who is the CFO of the company. So let's go through the conversation which they are having, and it is very interesting. Chairman is saying that, I'm really glad to note that the company has made a profit of over 8,75,262 rupees in the very first year. So chairman is very happy that in the very first year of its operations, the company has made a remarkable amount of profit, and feels that given this amount of profit, company may declare a dividend of 5% to their equity shareholders. This is what chairman is proposing, that we must pay 5% dividend to our equity shareholders, because it is this being the first year of its operations, and company has made a profit of rupees 8,75,262. Now here comes the role of CFO. CFO Ms. Hansa says that, sir, it had been a good year in terms of our financial performance, but she is skeptical about the payment of dividend to the shareholders. She is not very clear about the payment of dividend to the shareholders, and she is citing a reason also. But before that, chairman is having a very obvious question, that if I calculate 5% dividend on the total value of equity share capital, which is rupees 44 lakhs, it comes to be rupees 2,20,000 only. This is the calculation of chairman. that 5% on total capital of 44 lakh comes to be rupees 2,20,000. And he says that we can easily pay out this amount of dividend from the profit of rupees 8,75,262. So the question is, what is the problem? When the company is having a profit of more than rupees 8 lakh and it is supposed to pay a dividend of rupees 2,20,000, which they are planning to propose, what is the problem? Now the CFO reports that, sir, we have adequate book profit to pay the dividend, but the company is running short of cash to pay, as their cash balance is only rupees 37,850. Now the CFO is citing a very valid reason that, sir, although our book profit is rupees 8,75,262, but we are left with the cash balance of only rupees 37,850. And this actually makes chairman little inconvenient with the discussion and says that I really fail to understand your accounting calculations. So if the profit is 8,75,262, then where the cash is lost, where the cash has gone. Now the CFO is trying to explain the cash position to the chairman and is seeking your advice. Now with this conversation, if I ask you, what should be the remedy? Company is having its balance sheet, company is having its own income statement. Despite the fact that company has made a book profit of rupees 8,75,262, what is stopping the company from the payment of dividend of rupees 2,20,000? On what ground CFO is saying that, sir, we may not be in a position to pay dividend? Is it merely a cash balance? Should we go to the cash book, or we should look into the other matters also? What is the reason behind it? Some people say that, sir, simply we should go to cash book and have a look at the cash balance, and the answer is from within the conversation, where the CFO has reported that they are having a cash balance of only rupees 37,850. So company may not be in a position to pay dividend. So at times this kind of small caselet is given to the learners in their examination to attempt, and they are simply writing a line or so and assuming that their job is done, but they are incorrect into their approach. Here you are not only supposed to tell the reason where the cash is gone or where the cash is lost. You will have to tell the reasons also, that what are those avenues where the cash has gone, which means that the answer to this question will not come from the cash book. Answer to this problem is statement of cash flows, and it is actually a statement which is solving the problem of such questions when you have this doubt that despite the fact that company is having good amount of book profit, what is stopping the company from paying dividend? And solution to that problem is statement of cash flows. Prior to this Ind AS 7, let me tell you briefly that what is the rationale of calling it statement of cash flow, because most of the learners they are knowing it, they have been calling it for long in the name of cash flow statement, or in short they were calling it CFS, that is cash flow statement. Prior to Ind AS 7, we used to have a standard, as far as India is concerned, we were having AS3, Accounting Standard 3, which was later revised also, AS3 originally and AS3 revised as well. So at that time it was numbered at 3 in the name of Accounting Standard, and we used to have a format for it as per Accounting Standard 3 for preparation of cash flow statement. But with the emergence of Ind AS IFRS in the name of Ind AS, now it is renumbered and it is being called as Ind AS 7. And Ind AS 7 essentially renames this cash flow statement as statement of cash flow. So one point must be clear to you, that we shall not be calling it at all cash flow statement. This point onward or henceforth we shall be calling it statement of cash flow. Why so? I told you the reason, because as per Ind AS 7 it has been renamed and we call it statement of cash flow. If you look at the annual report of any company, apart from your income statement, your balance sheet, you will essentially find the presence of statement of cash flow, and it is one of the essential statement to be submitted by the company as per LODR as well, that is listing obligations and disclosure requirement. If you remember in the previous lecture of mine, when I was telling you about the annual report, disclosures in the annual report, I had a discussion on this, that statement of cash flow, that too as per indirect method shall form part of disclosure as per LODR, that is listing obligation and disclosure requirement. So the statement of cash flow, which is essentially a part of your financial statement, it is pertinent for us to know how it is prepared, what is the rationale behind preparing such kind of statement, and how we can solve this problem. This opening case with which I have started my discussion today, I shall be solving it in due course of my discussion on the topic of statement of cash flow, and I shall be answering to the question of chairman of Budding Entrepreneurs Limited, that where the cash has gone, by the way of preparing statement of cash flow. So let's begin our discussion with the statement of cash flow. Why do we need statement of cash flow? There is a very basic reason behind it. If you look at the balance sheet, or if you talk about the income statement, to which we also call as profit and loss statement or profit and loss account, it is providing you the basic useful information about the financial health and financial status of a company. If you look at the financial statement, when I say balance sheet, it is showing the financial position of the company, and when I say profit and loss account, it is telling us about the financial performance of the company. So these two performance and status, that is called position, is being explained by these two statements. But if you look at the profit and loss account, this profit and loss statement or account is based on certain principles. To name a few, it is accrual principle, it is matching principle, and cause of following those two principles, that is accrual and matching, this profit and loss account is not able to tell us about the cash generated by the enterprise or cash used by the enterprise. So where from and where gone, from where the cash has come and where the cash has gone, that we cannot find out. We can simply go to cash book and we can find number of transactions on the side of receipts and number of transactions on the side of payments. But categorically at one place you cannot find a classified information that where the cash has gone and from where the cash has come. We are only having the opening balance and closing balance of cash. And if you look at profit and loss account, that even it doesn't tell us about the cash balance. It is the balance sheet which is providing us the information regarding the cash balance. So the opening closing cash balance of last year automatically becomes the opening cash balance of current year. So my dear learners, cause of following these two assumptions of accrual and matching principle, our profit and loss account fails to provide us the details about the cash generated by the enterprise across the period or during the year. Now the same is the case of balance sheet. Likewise, if you look at the balance sheet, it is a summary of asset and liabilities at the end of the year, and it doesn't inform the user about the sources and uses of cash. It is simply telling you about the accounting equation, that asset is equal to capital plus liabilities. So capital plus liability must be equated with the asset, but we are not able to get the sources and application of cash during that accounting period, cause the cash is generated and used by an enterprise through operating activities, investing activities and financing activities. So broadly speaking, if we have to classify the activities in which business is going to use cash, or you can say generate cash from them, it can be classified as operating activities, investing activities and financing activities. These are three important actions by a company. These are three important avenues where companies either spending or generating cash from operating activities, spending or generating cash from investing activities, and lastly from financing activities. So cause of the very limitation of your balance sheet and profit and loss account, we need a statement. We need another instrument, we need another financial statement which can solve this problem of ours. That how to know, can we have a statement which can tell us categorically that, see, this is your opening cash balance and this is your closing cash balance, and in between these two balances, so between the two balances, where the cash has gone, what all has happened, we want to know. We are interested in knowing as a stakeholder that amid these two balances, one is the opening balance of cash, another is closing balance of cash, and that is why most of the teachers tell you that for preparation of statement of cash flow or erstwhile cash flow statement, we need balance sheet and profit and loss account of 2 years. But the question comes, some people go to that extent of saying that we cannot prepare a statement of cash flow unless we have the balance sheet and profit and loss account of 2 years. My question is, normally it happens. My question is, can't we prepare a statement of cash flow with the balance sheet and profit and loss account of 1 year? Most of the students say that, sir, no. I say yes. In the very opening case, I told you, what if the company is having its first year of operation? So can company simply say that we have not prepared statement of cash flow because we didn't have the balance sheet and profit and loss account of 2 years? Can it be possible? Is it possible? Answer is no. So even when you are having balance sheet of 1 year, then too you may prepare statement of cash flows. It is very simple. If you don't have any cash balance of last year, assume the cash balance to be 0. What is the harm? So don't you think it would seem illogical if you say that we can only prepare the statement of cash flow when we have balance sheet and profit and loss account of 2 years? If you say, will it be logical? No, not at all. So you will have to understand that yes, normally we need the balance sheet of 2 years. It is the normal course of operation that we have, the 2 years of balance sheet, we have 2 years of profit and loss account. With that, we are trying to find out, we are trying to witness the movement of cash from one transaction to another, from one head to another, and then we are coming up with a statement, in a classified format. One place we are informing you, the journey of opening balance till closing balance. So the complete journey of opening balance of cash till the closing balance of cash is being witnessed and explained categorically and in a classified manner by statement of cash flow. So the statement of cash flow is prepared to solve this problem, to take care of, to tackle, to cater to this very limitation of balance sheet and profit and loss account. Since they are not able to provide solution to this question of ours, that how to find the cash position of a company. So right way is that you prepare statement of cash flows. Now coming to the purpose of statement of cash flow, what is the purpose behind preparing statement of cash flow? What is the objective? The objective is very clear. It is a statement which provides information about the inflows and outflows of cash. When we say cash flows, flow can be of two types. One is inflow, another is outflow. It is very, very clear also with its nomenclature itself. Inflow means the receipt of cash. Outflow means when you are paying cash. So receipt and payment of cash, they are classified as inflows and outflows. And this statement is providing you the inflows and outflows of cash in three broad classifications. One is operating activities, second is investing activities, and third one is financing activities. I shall be telling you in detail what do we mean by the term operating activities, what do we mean by the term investing activities and financing activity. But yes, this is the classification. This is the broad classification of explaining this cash position, cash flows, that inflow and outflow in each category we are supposed to, for each activity we are supposed to provide in a classified manner. So if you ask me, to my mind, what is the objective of statement of cash flow, I would give you a single line answer that it is going to provide you the cash flows, which means inflow and outflow both. The cash flows related to three broad activities, that is operating, investing and financing activity. So the format itself will clarify, the format of statement of cash flow itself will clarify, will give you a reflection that this is the way we have to prepare our statement of cash flow. Now what is CFS or what is statement of cash flow? Because most of the students, they are accustomed to calling it as CFS. I have written it, what is CFS? So cash flow statement is depicting you the inflows and outflows of cash during an accounting period. And mind here, my dear learners, it is basically a reconciliation. You are actually preparing a reconciliation statement of the opening balance of cash and cash equivalents with the closing balance of cash and cash equivalents. Now here I have used a term called cash and cash equivalents. Some people say that, sir, we'll have to calculate cash and then we'll have to calculate cash equivalents. My dear learners, mind here, cash is never calculated, cash is counted. We only count cash, we don't calculate cash. And most of the learners, they are using this term interchangeably, that, sir, either we call it calculate or we call it count. What is the difference? There is a difference. When I'm saying that I have a cash balance, I'm not supposed to calculate it. I'm supposed to only count it. I'm only supposed to count, go to my passbook and see what is my cash balance as on date. So cash and cash equivalents need to be explained here. This is a new term to you. This is a term which is new to you in while having our discussion on the statement of cash flow. What is cash and cash equivalents, that I'll be elaborating as per Ind AS. But as of now, I would first tell you, in AS 7, the cash flows of an enterprise provides you, you or you can say users of financial statements, a basis to assess the ability of enterprise to generate cash and cash equivalents. So this statement of cash flow is helping you in assessing. You can do the assessment of the ability of your business enterprise about generating cash and cash equivalents. What is your capability as an organization? How much cash you can generate, and from which activity you can generate? Where is the point? What is the point where you have to work, where you have to actually look into that this is the point where my cash is being lost. This is the activity where I'm not able to generate adequate or sufficient amount of cash. So this statement of cash flow becomes a basis for you while conducting your assessment. You wish to assess the ability of your enterprise in generating cash and cash equivalent. So where to go, which statement to refer? Answer is statement of cash flow. And apart from conducting this assessment of ability of your enterprise in generating cash and cash equivalent, it also tells you, it also helps you in finding out the needs of the enterprise to utilize those cash flows. That what is the need of you as a business enterprise to utilize these cash flows, where to utilize, how to utilize it in a proper manner. So Ind AS 7 also prescribes that the very motive of preparing statement of cash flow. It says that if you really wish to know about the cash inflow and outflows of the company, we should have a statement called statement of cash flow. Now a very popular term which I have also used here and which will come time and again while preparing the statement of cash flow, that is called cash and cash equivalent. So I personally feel that before we go ahead, we must understand the very meaning of cash and cash equivalents. Although I told you that cash is never calculated, it is counted, and cash equivalents you need to understand. What is that instrument which is equivalent to cash? What is that item? What is that instrument? What is that term which can be considered as equivalent to cash? So cash equivalent, what is that? We need to understand from the mirror of Ind AS 7. See, what is our understanding? That is a different thing. You go to market without any cash, you purchase certain goods, and you say this is my credit in the market, that without any money, I forgot my wallet and I forgot my phone. I went to the market, and since people know me, that's why they have given me credit and I have availed that credit, and you call it as cash equivalent. Now the question comes, this is what is your understanding about cash equivalents, but what Ind AS 7 says, that is more important. So when you say cash, let's be very clear about what is cash and what is cash equivalent. So if somebody is asking you what is cash, some people say that sir, whatever is cash in hand with me, whatever is in my wallet, whatever is in my cash box, if I am a shopkeeper, that is my cash. But answer is incorrect. Answer is incomplete. If I say that see, I don't have any money into my wallet, but I have my credit card with me, my debit card with me, or I have my own payment bank with me in my cell phone, can't I use it? Answer is yes. So is it cash? You may say that sir, it is cash equivalent, but I would say no, it's not cash equivalent, it is cash. Whatever demand deposit you are having with your bank, that is your cash, that is counted as cash. You cannot call your demand deposit to be cash equivalent. So remember, whatever money is there with you in your bank account which can easily be withdrawn, that is called cash. So either you are keeping cash in your wallet or you are having demand deposits with yourself, that is classified as cash here. But what if you have term deposit? It is having a certain expiry period. For that comes a classification called cash equivalents. Because when I say that see, term deposit will not be counted as cash, so you would say sir, then in that case it would be cash equivalent. Now can every term deposit be called as cash equivalent? For that we need to refer to Ind AS 7. Any short term liquid investments, mind here, any short-term liquid investments if it is having a duration of 3 months or less. If the duration of your short-term liquid investment is 3 months or less, so any term deposit which is having a duration of more than 3 months doesn't qualify to be called as cash equivalents. And that is why I said I cannot tell you that every term deposit is your cash equivalent. The reason is very clear. So any short-term liquid investment, if it is having a duration of 3 months or less, that shall only be called as cash equivalents. If you have any readily convertible instrument which is having where your risk is insignificant, that shall be classified as cash equivalents. So with this classification of cash and cash equivalents, I hope you must have understood what is the clear difference between the cash and cash equivalents. To clarify it more, I would cite some examples. I would show you the two scenarios. Scenario 1. Suppose I am telling you about a business entity which has acquired a 3-year fixed rate government bond in an active market 2 months before its maturity. Now here there are 2 periods which is mentioned into this scenario. One is you are going to buy a government bond which is having a total duration of 3 years. But at the time of purchase, you are left with the maturity period is left for 2 months only. So you are 2 months away from its maturity. So your question is, can I call this bond cash and cash equivalent? Answer is yes, I can call. Despite the fact that this bond is having a maturity of 3 years, but still at the time of purchase we are only 2 months away from maturity, so it qualifies for that period of 3 months. Number 1. Number 2, since it's a government bond, so risk is insignificant, so I would without any hesitation I would call it to be cash and cash equivalent. Another scenario where you are making use of the bank overdraft. Your general bank fluctuates between having a balance and overdraft in accordance with the cash receipts and payment cycle. The overdraft is repayable on demand. Question is overdraft part of cash and cash equivalents? Answer is yes, cause overdraft is always payable on demand. Whenever you are willing to use it, you are availing it, but on demand you will have to repay, and if you don't pay, you'll have to pay interest on that. So with this, my dear learners, I tried to tell you briefly about the introduction to statement of cash flows. I tried to explain you the term cash and cash equivalents. In the next lecture of mine, we shall continue our discussion on the statement of cash flows. Thank you so much.